Good afternoon to everyone. Welcome to our tutorials, and today we are proceeding with our series on financial reporting. And basically today we are going to talk about IAS 23, that is borrowing cost. And before I go any further, what you should know is that when the business is doing certain activities, if it needs to invest money, if it needs to construct assets, or it needs to buy assets, what it does, it goes for looking for sources where they are going to get the money for investment or for constructing of those assets or buying the assets that are going to be used in the production and all that. So there are certain items that the company may look at and decide whether to go for an internal borrowing by using the internally generated profit, or to go for an external borrowing. And an external borrowing, they may be in terms of long-term loans, they may be using overdrafts, they may be using bonds, debentures, and at the same time they may be using preferential shares, the one that are redeemable. That's what we call the debt. But the one that we get from the shareholders, that one is not supposed to be covered within the scope of this standard. So whenever you see it, just know it's just confusing you. But the one we basically look at is that the money we've got from, let's say, loans, bank loans, we've got from debentures, bonds, and basically the one for preferential shares, but mainly the one that is redeemable. The one which is irredeemable is shares, so it's also not supposed to be included. So when you get that, remember when you go for an external borrowing, it means you are going to incur certain amount of money to pay back the interest and the loan amount you have taken, plus other costs. Of course, when you go for an external borrowing, or when you go for borrowing, and you expect that you are going to be incurring interest, that is the main thing. When we talk about borrowing, someone just understand that you are going to be paying interest. But remember, you are not only paying the interest alone. There are other costs that you are going to be paying on top of the loan that are covered within the standard. And some of them you may talk about when you are going, let's say, to borrow money from the bank. They may charge you processing fees. They may charge you like initial deposit, that you first make this amount on our account before we give you this money. They may charge you processing fees and other. If, let's say, you are going for issuing bonds, there is a cost you are incurring, cost of advertisement and all that. For example, when you saw MTN going for borrowing from the public, they incurred some advertisement costs and others. So all that is what we call the borrowing, the costs that are supposed to be capitalized. Then what will happen to the normal way we do the business? The big question will be, how are we going to treat the interest that we are going to be paying for the loans that we have acquired, for, let's say, for construction. If they are going, if at all we've got the money is for construction of, let's say, qualifying asset, that one we are going to look at it. If, let's say, you've got that money and the money is going to be, part of it is going to be for construction and the other one is going to be for used as working capital, how are we going to be treating that interest? Are we going to be capitalizing, or we are going to be expensing it? So that's basically what we are looking at when we are looking at the standard of IAS 23. And IAS 23 gave us a solution for that, as we are going to be seeing. So what you have to first of all consider is that, what are you going to do with the money you are borrowing? if the money is going to construct a qualifying asset, then that amount of interest that you are going to be paying plus other interest, they are supposed to be capitalized. So let's first know what are borrowing costs. Borrowing costs, we are saying this refers to financial costs or interest incurred in using borrowed funds to construct a qualifying asset. That one shouldn't be missed out. That money should be used to construct or acquire a qualifying asset. And we are saying a qualifying asset is an asset that takes a substantial time to get ready for its intended use or sale. You may be borrowing money to construct houses for resale in terms of inventory. But the issue is, are those buildings you are going to construct, are they going to take a substantial period? Remember, the substantial period is not defined by the standard. But at least when you talk about something that is going to take long, accounting wise, we can say something that exceeds 1 year. We can say that one, at least it is taking a long period. Something that it goes for 2 years, 3 years, and 4 years, we can call it, so long as we are going to acquire something or construct something that is going to take a substantial period of time to get ready for its intended use. If, let's say, someone says, I'm buying a car, is a car a qualifying asset? Of course, when you buy a car, when you pay it, you get it and you start using it. That one you cannot qualify. Even if you have used the borrowed funds, it cannot qualify because it is not a qualifying asset. A qualifying asset means that asset is going to take a substantial period, at least more than 1 year, for it to get ready for its intended purpose. So that's basically what we can talk about definition wise and the scope of what we are going to be seeing. But as the definition says, this refers to financial costs or interest. The reason why they are giving these financial costs, it means that financial costs are many. But basically what we know interest, but it's not interest alone. We have certain other costs that are supposed to be capitalized as far as interest is concerned. Even interest is supposed to be capitalized, is one of our financial costs that everyone knows. But there are other costs that are supposed to be capitalized in the same way we are going to be doing for interest. One, we have some examples, and we are saying we have interest on short-term and long-term loans. That's our first instance. Of course, that one everyone knows that interest, either interest is on overdraft, short-term, whichever, so long as it's money that we are borrowing and it's not shares, then it's supposed to be included. Second thing, you can talk about the financial costs that are related to leasing transactions. Of course, when you're talking about this leasing transaction, those ones, they are in reference with the IFRS. That's IFRS 15 that handles those leases. So that one we can talk about it maybe in the next slide as we are going to be looking, because we are going to be looking at it as a separate item. But what you should know, that those that are related to that, they are supposed to be part of those that are related to leasing transaction, that is IFRS 16, they are supposed to be part of the borrowing cost, and they are supposed to be capitalized. Then we have other foreign exchange differences. These foreign exchange differences, it happens like if, let's say, you get money from an external or international bank or whatever financial institution you are borrowing the money from, you may find that at the time of paying back the interest, you may find that you borrow when the interest, when the exchange rates are, let's say they are low, and by the time you are paying back, the exchange rates have increased. That difference is supposed to be capitalized, because it's a loss. We are incurring a loss. Instead of paying less amount, we are paying high amount, but they came as a result of the changes in the exchange rates. So we are supposed also to give that to make sure that we capitalize that, but we take the one that is related to the interest, not to the whole principal. It is interest related. Then the other one we can talk about is we have the discounts. If at all you have been given let's say a bank loan, and that loan has they have given you some discounts, you may find that those discounts are supposed to be, when let's say they give you a discount. Let's say the total loan was let's say was 1 billion, and they are giving you a discount, less of a discount of 10%. But remember, you are supposed to pay an interest on that loan. Let's say the interest was supposed to be 5%, and they are giving you a discount. What you should differentiate is that the loan interest is supposed to be per annum. Whichever, there is no way you can, if let's say they have given you 1 billion and you are supposed to repay it for 5 years, the interest you are paying, the 5%, is supposed to be on an annual basis. Meaning, if you have a discount, this discount is supposed to be on the whole loan amount, whether it is going to be for 10 years, the useful life. Meaning, it is going to be the discount of 10% times the 1 billion, whichever figure you get, is supposed to be for the whole like long-term period. Which means that to get for only for 1 year, which we are accounting for, you are supposed to first amortize that installment. If let's say the 10% of the 1 billion, it is, let's say, you can say 100 million, you divide it by its useful life, the useful life of the loan, then you pick that portion for only 1 month. Because when you are given a discount, if you are buying, the discount is given on the whole figure. But remember, the interest is accruing every year. So to get the other discount that is supposed to be less from the interest we are going to be paying, you are supposed to treat it as amortizing that installment, and you get for 1 month for that 1 year, so that you can be able to deduct it from the interest. Then the other one, you may talk about if it was premiums. They may tell you that we are giving you a loan and you are paying interest of 5%, but there are other charges. Let's say you are going to be paying interest of 5%, but you have administrative cost of, let's say, 2% over 1%. It depends on whichever terms that are there. Then that administration cost is going to increase on what? On the amount you are going to be paying back. So that administrative cost that you are paying back, they are increasing. So at least for them, when you are looking at those premiums, for them they are supposed to add back. We are supposed to add back on the interest, but they are also supposed to be amortized, because they can say you are going to pay an administrative cost at the end of the period, or it is going to be the administrative cost for that 1 billion you are taking is 6%. You get 6%, you amortize it, the answer you get, you add back to the interest. It will make that gross that is supposed to be capitalized. Hope you can be able to get that. The other one is we are going to be looking at them if at all we get to do a practical question. You'll be able to understand most of the things as we are discussing them. We said that the qualifying asset, you have to make sure that asset, it takes a substantial period, and we said the standard doesn't define the substantial period, but at least you take it for 1 year, more than 1 year. Something that goes for more than 1 year, at least you can base on that and say, of course, when they are giving you the question, they will suggest, they will give you a period, and you will be able to understand whether it is qualifying asset or it is not. That's basically what we can look at as far as the definition is concerned. But let's also try to look at what are some of the recognition criteria. How do you know that you are supposed to have these borrowing costs? The recognition criteria, and we are saying that an entity will capitalize borrowing costs that are directly attributed to the acquisition or construction of a qualifying asset. We say the principle is that interest is supposed to be directly attributed to the qualifying asset. If at all, let's say you wanted to borrow 1 billion as the amount that you are going to use to construct a qualifying asset, but instead you end up borrowing 1.5 billion, and that the difference, remember the asset needed only 1 billion, but for you ended up borrowing 1.5. It means that 0.5, which is the difference, is not supposed to be capitalized. For it, since it is going to be used as working capital, it's supposed to be expensed. So when you look at the question may come and it is a bit tricky to the extent that they are mixing in the part that is supposed to be related to the qualifying asset and the other is not related to the qualifying asset. So you can be able to assess that. And we are saying that if you have confirmed that the money we are borrowing is directly for construction of a qualifying asset, then that asset we are going to be constructing should be able to give us these. One, we are saying it's probable that future economic benefits will flow to the entity as a result of using the borrowed funds. Of course, when we use the borrowed funds, we expect at least what we have done to give us something in return. That's what we are talking about. And we said something to be probable must be beyond 50%. The other one is that the cost of borrowing can be measured reliably. If at all you can measure that the cost, then we recognize that as borrowing cost, and we capitalize it. And we have a note here, and we are saying all other borrowings that are not attributable to the acquisition of a qualifying asset must be expensed in the profit and loss. That's what I've been talking about. Can go to the next slide, and we try to look at how do you commence. How do you know that I'm supposed to start capitalizing borrowing costs? The standard gave us 3 main points that we are supposed to consider. One, we are saying that the entity will capitalize borrowing costs when it incurs expenditures on the qualifying asset. Of course, when you start incurring the expenditures, you automatically start capitalizing, because if you don't do so, then where are you going to put them? Are you going to expense them? The other one, when he actually incurs the borrowing costs, the same thing. When you incur the borrowing costs, capitalize them, because you have no choice. There is nowhere you're supposed to put them, so long as they are related to what? To the qualifying asset. Then the third one, this third one is very, very, very important, and it is very confusing. We are saying that when the entity undertakes activities necessary to prepare the asset for its intended use. Actually, what happens is that for you to recognize those borrowing costs, it doesn't necessarily mean that you are supposed to first start the production or to start the construction and you begin recognizing them. At one point, since this money is coming and it is coming to do something that is going to take a long time, it means that there are certain procedures or there are certain steps you go through. If let's say you wanted to construct a building, you are supposed to first of all get the plan approved by either the district or the council, whichever is there to approve the plan. When you've got that plan approved, then you can proceed. In that period, when you have acquired the money but you have not yet started the actual the actual construction, but you have already gotten the money, you start capitalizing, because those activities we are doing at that time, they lead to, because there is no way you can start construction when you have not got the plan approved. Those are basically the things we are talking about. We are saying obtaining permits. Permits, we can talk about them like getting the plan approved and all that is needed before you start the construction. So it doesn't mean that you are supposed to consider this borrowing cost when you have actually started the production. You are supposed to consider them so long as these activities, they lead to the construction of that qualifying asset or the acquisition of that qualifying asset. We capitalize. Then let's look at what are some of the scenarios whereby you can reach at a point and you say, I'm suspending capitalizing borrowing costs. It may happen. And we are saying that the standard says the entity suspends capitalizing borrowing costs during the time when no active development of the asset is taking place for an extended period of time. But what you have also to know is that the extended period of time is never defined by the standard. So, and if the extended period of time is not defined, don't just assume that even for the shortest period, that it may be you are waiting for materials to come, then you some suspending. Because if let's say you are just waiting for some materials for a few days, maybe people have not turned up, the workers have not come for one day, and you are saying you are stopping capitalizing for that one day. Doesn't make sense. Meaning that the period we at least consider, there is maybe a time for the COVID suspensions. Of course, we had everyone was supposed to be in the house, they were not working, and everything was not going like the way it was used to be. Then you say at least since it is COVID period and the government said we are supposed to stay at our places, then you just know that at least for that period, the reason is genuine. You can base on that and you say because they have suspended end movements and all that, even the construction, then for a certain period of time, at least you can base on that and you say, for this period, I'm going to be expensing these costs. Suspending doesn't mean that you are going to ignore them completely. You will be expensing. One of the things that you will be benefiting when you are when they are expensing them for that period, it means you are going to be paying less tax. Because when you expense them, remember they are huge. When you expense them, it means they are going to be reducing your net profit. As the net profit is reduced, it means even the tax is going to be less. So for that time, so long as the period and the reason is very genuine, you can be able to suspend and say, I'll resume capitalizing those costs when we also resume working, or we resume on the operations. When we are talking about capitalizing, what we basically mean is to add back. We add this amount of interest to the cost so that it becomes part of the cost of the asset. So when we say that the entity suspends capitalizing borrowing cost during the time when no active development of the property, we are not doing anything, especially for example, during COVID suspension days. Then the other one is, we have a note and we are saying the entity does not suspend capitalizing borrowing cost during times of temporary delays. This is what I've been talking about. Temporary delays, we don't, like you're just waiting for materials to come, the materials are done. Even when you are taking technical and administrative work, that one we talked about it. If you are obtaining permits, you don't suspend. Even if obtaining permits takes a long period, even 1 year, you keep capitalizing, because before you get those permits, you can't start the operation. And we are saying another note is that borrowing costs are considered when the money is obtained borrowing costs, we are saying that borrowing costs are considered when the money is obtained, not necessarily when the production or the acquisition is incurred. This is basically what I've been explaining, that when you look at when you get the money, because the first thing is that when you start incurring the borrowing cost or when you incur the expenditure. But when you get the money like this, you start capitalizing, even though the actual production has not yet started. So we can basically look at another scenario whereby that there is a situation where you are going to be suspending, actually you'll be suspending, or you cease or you stop capitalizing the borrowing cost. What are some of the conditions that we may look at that can lead someone to stop capitalizing borrowing cost? One of the scenarios we can talk about before even we go through the notes is that when the actual construction gets done, you've been constructing that, let's say a building for let's say 2 years, and the building is now finished. Of course, by the time it is finished, then you are expected to stop capitalizing. And we are saying that any entity stops capitalizing borrowing cost when all activities necessary to prepare the asset for its intended use are complete. When everything is done, then we can say, let's stop capitalizing borrowing cost. Then, having looked at some of the conditions that we may need, then how are we going to be recording? We've seen that we've seen the recognition criteria. Then which costs are we going to use? Sorry, how are we going to measure? Which value are we going to assign to our borrowing cost that we are going to be capitalizing? That is the measurement of borrowing costs that are eligible for capitalizing. And the being eligible, we said that that money should be related to the construction of a qualifying asset. And we are saying that there are two scenarios. One is specific borrowing and the other one is general borrowing. Specific borrowing, you can look at it in two ways. One way you can look at it is that the company got some money, either in form of giving bonds or from financial institutions through those bank loans, or it has gotten money from private lenders. And you're seeing that money comes with a different interest. The other one will give you with this interest, and the other one will give you also another interest. But the reason why we are acquiring this money is to construct a specific project. We are looking at something that is there pending for us just to get the money, and we resume the construction. Maybe if you wanted to construct a building, or let's say a warehouse, and we are looking for money of where we can get the money from different sources, but that money is specifically aided for the construction of that, let's say, warehouse. And to a certain extent that we may even get that money, since the money is going to be used in the in the construction of that qualifying asset. It means we are not going to do the construction at once. If, let's say, when we receive the money like this, we finish everything at once. You may find that since that qualifying asset is going to take a substantial period of time, it means we are going to be incurring those expenditures year by year, meaning the money we've got is going to be used for a different period of time before it gets done or before the construction ceases. And we are saying that if that money we have, because we already have the money, we got it, and we are now using, we estimated that if maybe for 1 year we are going to use half of it, but we use the other half maybe to do other investment. We earn some investment income after maybe investing that borrowed money somewhere. So what will happen is that we will get the money, the borrowing cost that we've incurred on the for that period, and we less that income that we've received, the investment income. But there are some scenarios whereby you may get, let's say, you got a bank loan of, let's say, 1 billion, and it's supposed to be for 5 years. Supposed to be paid for 5 years, and at the end of the day, you use maybe for 1 year, you estimate that you are going to be using, let's say, 100 million for 1 year, or 200 or 500, depending on whichever. Then you invest part of the money. What will happen is that the other investment may take also like 2 years to get back the money you invested somewhere to earn some investment income. And when we are computing the borrowing cost, remember we are reporting annually on an annual basis. It means that investment income we have got, we have to amortize it so that we get for only one accounting period. If at all maybe that income is coming in for 1 year, then we are supposed to less it the way it is. But if it comes in, let's say in 2 years, we amortize it, we get for 1 year, and we less that amount from the borrowing cost we've computed for that 1 year. That's basically how we can be discussing about the borrowing cost, the specific borrowing. The other way maybe you can talk about it is getting a one loan from one, let's say, financial institution, even if it is not like combined. You've got the money from one specific source, and you are using it. If it's coming from one person, then it's good, because you are not going to be having different interest. Of course, when you have different interest rates, we are going to see in the general borrowing how do we treat that if at all we get the money from different sources and each source has a different interest rate. We are going to see how we get the averages and with the weighted average that we are going to be using. Then what we are saying is that the important thing is to remove the investment income if it is there. Since that money we are using for investment is not going to be, the money we are using for construction is not going to be used at once. We are saying that this is where an entity borrows funds specifically to finance the acquisition or construction of a qualifying asset. The borrowing cost to be capitalized, they are determined as we get the actual borrowing cost incurred during the period minus any investment income earned on a temporary investment of the borrowed funds. But remember, for us, we are only accounting for the interest component and other costs, not the whole loan amount. Here we are only interested in these charges that we are supposed to include back. Then we are saying, maybe to talk about the investment income, we are saying investment income arises as a result of using borrowed funds or borrowed money to finance other investments. As the process of construction goes on, since construction activities does not utilize all the money at once. That's what I've been talking about. That when you get, let's say, 1 billion, you're not going to use that, the whole of that money at once. You may use, let's say, 500, and the balance you can invest it in these short-term investments that can give you some money back. Then the other one is, let's talk about the general borrowing. General borrowing, as the word suggests, you may be also having the money, maybe you accumulated that money earlier, or you just go for it. You maybe you go for bonds, or you go for the bank loans, but they are, this time around, they are from different sources. And basically, when they are coming from different sources, we expect to be having different costs. Leave alone the interest itself, even the other costs, like the way I said, the administration costs, the advertising costs, that are directly attributable to the amount you are getting. You will see that those costs are going to be different. How are we going to be amortizing those different costs? But basically, we can look at the interest, because that's what is majorly in the borrowing cost. But don't forget, there are also other costs. And we are saying that to get those ones, we get, if you are to compute the borrowing cost to be capitalized, we get the weighted average borrowing, we multiply by the expenditure incurred. Remember the other one, the other specific borrowing, if at all the money was got from different sources, we are only multiplying, we are not multiplying by the expenditure that has been incurred, but we are multiplying on the normal loan. If, let's say, you've taken 5 million from a given bank and you've got a bond, you multiply their percentages to the figure, and then you less the whatever the investment income. But for this one, we are getting the weighted weighted average borrowing, but this time around we are multiplying at the expense incurred on the asset, what we have actually incurred. Those ones, when we do a question, we shall be able to understand more and more on that. But that's basically how we can deal with the borrowing costs. Maybe in the next slide we shall look at, we have here a trial number. Trial number is November, question 3B, November 2019. There's a trial number there. But I need you to first get these concepts and be able to, so that we can be able to at least understand the theoretical aspect when it comes to the computation we shall be going through. Because I take it in the sense that when you get to these, what the standard says, you can be able to do the computation, because you'll just be implementing what you have actually learned. The next video is going to be about the impairment. We see how we do the impairment of assets. We talked about it. We see how the impairment is handled, but that's going to be in the next video. So allow me stop here for now, as we link up for the next time. But I want to say that you guys be able to subscribe, and you'll be able to get whatever videos we are going to be posting. Thank you.